Right. Today I'll talk about S&P 500 quarter 3 earnings update. Right. Now, for an introduction, by mid-November, roughly 91% of S&P 500 companies had reported quarter 3 results, leaving only a handful, about 11 firms, including 2 Dow components, still to announce. Now, this near complete reporting universe covering virtually all large cap sectors provides a reliable picture of the quarter. So in practice, the remaining companies are unlikely to dramatically alter aggregate trends. So the current sample is regarded as sufficient to assess overall market results and sector patterns. Now, here is the quarter 3 results overview. All right, so this is the you can see the actual data versus the earlier estimates of the various sectors over here. So I did not include the real estate and consumer staples because they had smaller growth, right? So basically the broad story for the third quarter is clear. Earnings were much better than the market and expected at the end of the previous quarter. For the index as a whole, blended earnings per share growth for the quarter is about 13.1% year on year. Blended means that actual results from companies that have already reported are combined with the most recent forecast for the few that have not reported yet. So this 13.1% growth is far above the 7.9% that analysts were expecting at the end of June, and it marks the fourth straight quarter of double digits profit growth for the index. Previously, they anticipated that this quarter was only a single digit growth, but it surprised really, really well, up to the point where the beat rates were also unusually strong. About 82% of reporting companies delivered earnings per share above consensus forecast. Now, this is higher than the long-run average and signals that management teams generally execute better than the market has assumed. So on the top line, aggregate sales grew about 8.3% compared with a year earlier, the strongest revenue pace since the third quarter of 2022. Now, roughly 77% of companies exceeded revenue expectation, and all major sector banners reported positive year-on-year sales growth. Profit margins remain a major support for earnings. Net profits margin for the index were close to 13%, which is above the average of the past 5 years and close to the higher levels reached after the pandemic recovery. So in simple terms, companies are still managing their cost bases well enough that profits are growing faster than revenues. This reflects strong operating leverage across the corporate sector. Okay, so when we look across broad sector banners rather than the narrow industry codes, a clear pattern emerges. Technology once again lead the market. Earnings for the tech banner rose by more than 20% year on year, as large chip makers and major softwares and cloud firms continue to benefit from strong spending on AI and digital infrastructure. Some of the biggest internet platforms that are often associated with tech also contributed to this growth. Now, financials were also another major engine of profit growth. Bank, asset managers, and insurers together delivered profit growth of more than 20%, helped by resilient credit quality, higher fee income, and continued cost discipline. Now, industrials and materials also posted solid double digits earnings growth, supported by firm demand in transportation, machinery, and construction-linked businesses. Utilities and infrastructure names delivered similar double-digit profit gains as they passed through higher costs and benefited from steady demand. Now, healthcare and consumer discretionary showed more modest but still positive results, with low to mid single-digit earnings growth. In this banner, strong results at some leaders were offset by weaker performance in select sub-industries such as apparel and parts of traditional retail. Now, energy and staples were broadly flat, right, on a profit basis as low commodity prices and normalization after prior strength weighed on the results. Now, the main weak spot came from the communications and internet platform banner. Now, while many companies in this group posted stable results, a large one-time charge on Meta pulled the overall banner into a small decline for the quarter. That single event explains most of the negative contribution from this area rather than a broad collapse in communication-related businesses. So in summary, the third quarter, right, showed broad-based revenue growth and strong profits across most of the markets, with tech and financials acting as key leaders and only one major banner posting a small earnings decline because of an idiosyncratic event. Okay, so for the quarter four and for projections, analysts currently project only modest growth in quarter four, roughly 7 to 8% earnings per share growth year on year, implying a slowdown from the double-digit pace of quarter three. Revenues for quarter four is seen around 7.1%. Full year 2025 earnings are forecast to rise about 11.6%. So early 2026 is expected to re-accelerate with mid-teens growth in the first half of the year. So far, 58% of companies issuing quarter four guidance have warned of lower earnings per share, with 42 negative updates versus 31 positive. Now, this negative tilt is roughly in line with historical average around 57%. In aggregates, quarter four estimates have been stable to slightly trimmed, reflecting caution as companies face tougher comparisons against the year. Now, some sectors' forecasts have shifted after quarter three. Bank and financials have seen upward revisions because strong quarter three bank results lifted full year forecast. By contrast, communication services was marked down after the shock to Meta. Earnings prompted analysts to cut estimates. Energy also faces downgrade given lower oil prices. Overall, analysts expect most sectors to stay in positive growth, although at a slower pace, with financials and tech likely to contribute more of the upside and a few defensive or commodity sectors lagging. On 11 November, consensus call for about 7.5% earnings per share growth in quarter four and roughly 11 to 12% in early 2026. These projections imply that earnings momentum eases in quarter four, but strengthens again next year if the macroeconomic environment remains positive. Okay. So for implications to the S&P 500, even after strong quarter three earnings season, the S&P 500 trades at a high multiple. The forward 12-month price to earnings ratio is about 22.7, above the 5-year average near 20. So this rich valuation reflects optimism as analysts aggregate price targets imply roughly a 17% upside over the next year. Any continuation of elevated profit margins and earnings growth might justify these levels, but valuations remain tight. The hefty quarter three bid rates have boosted confidence. Broad participation with 8 of 11 sectors reporting year-over-year earnings gains suggests that rally is not purely narrow, even though a few mega caps tech names still dominate performance. So as long as earnings keep coming in strong, sentiment should stay positive. However, market gains have been focused in leading sectors such as tech and finance, so expectations for these companies are high. The main risk right now is that lofty expectations collide with slow growth or external shocks. So with margins already near peaks and valuation stretch, there is limited room for error. So December will be very crucial because any surprise slowdown in key sectors, for example, pullback in tech spending or period of sustained high interest rates, could trigger a contraction in valuation multiples, right? So other uncertainties such as persistent inflation, change in Fed policy, or the effects on government funding disputes could also temper growth. So in short, the outlook for S&P 500 still appears reasonably bullish given quarter three strength, but it depends on continued execution. Should growth stall, the narrow valuation cushions leave market vulnerable to downside. Okay. So hopefully you have a better understanding right now of this. So at the end of the day, we have people screaming on YouTube or say there is this AI, what do you call, bubble and stuff like that. Now, we just go back to the logics. Okay, so if the companies are still earning money and they're earning higher and higher each quarter. I don't think there is a reason to, worry much. We have seen the S&P 500 retracing by huge margin, and everybody screaming that it's going to crash. But lo and behold, we have seen the current down move that we've seen in the market. For the S&P 500, basically they have recovered about 1/3 of that movement already. So if this momentum continues, yeah, the market can see all-time highs again. Given that we are looking at the earnings, they're still healthy. Q3 was supposed to have that 7% growth, but we have seen double digits again. So they are projecting 7.1% for Q4. Again, like I said, the market could surprise, you never know. Until there is a change in the earnings, okay, by that causes concern, I think the market could continue to move higher. Okay, so with that, that's the report for today.